James, thank you for joining us. How did the managed solutions fare in December?
Well, we had a good November, if you recall, and December was a little bit weaker than that. We had a degree of relative underperformance. It's a consequence of our asset allocation and manager selection. We'll come on to that later. I suppose it's a similar story over the year. We had a good 2013, 2014, a little bit weaker really in a relative sense. Over longer time periods, since inception, for example, the majority of the funds ahead of the benchmark net of all fees, and that's a decent long time period now. The funds are ahead of their benchmarks.
James, what then were the main themes for the month?
Well, I suppose it was a continuation of what really defined November, the fall in the oil price, weighing on the energy sector particularly. Global equities were down over the period, about 1.6%, as the US, UK, Europe and Japan all posted negative returns in their respective local currencies. Emerging markets underperformed, down about 5% over the month to cap what was a pretty average year for emerging markets, in fact. Turning to the year, global equity up about 5%, driven strongly by the US and other reasonable returns from regional equity markets, but translating into US dollars, they were hampered a little bit by the strength of the US dollar. Emerging markets down around about 2%. And that's the second year in the row, in fact, that we've had emerging markets produce a negative return. And it's the first time in 12 years we've seen that, so not a good little period here for emerging market equity. Turning to the debt markets, emerging market debt, while we're on the subject, did pretty well, up 6%, which is in line with the US Treasury market on the hard currency side of the emerging market debt market, which is not bad given the negative sentiment to the region as we've seen in the emerging market equity market. Fixed income generally did well. Government bonds particularly doing pretty well over the year. The US 10-year started the year at 3%, moved down to 2% by the end of the year. Pretty much a linear move, not completely of course. The UK gilt doing roughly the same, so producing decent positive returns over that period. Credit markets didn't really do quite as well on the whole. We had a reasonable time for credit, helped by that move down in the reference rate, but generally spreads not doing enough to sort of add to that return, so we had sort of mixed fortunes in the credit market really over that period.
James, we're now in January, a good time therefore to look back at the previous 12 months. What were the main asset allocation drivers behind performance in the managed solutions in 2014?
I suppose there were three main elements, two of which are truly asset allocation and the third is manager selection, arguably. So we should have had more government bonds in the portfolios. For example, the US 10-year moved from 3% to 2% in almost a linear yield move over the year, and that represents a decent capital gain, around about 6% from the US Treasury last year. We got almost double that from the UK gilt market, would you believe, as their yields moved similarly. So while we came into the year thinking government bonds were reasonably expensive, they became more expensive as the year progressed, and provided decent returns for investors, and we'd have been better off there than pretty much any part of the credit markets, in fact. So that's part of it. Our neutral-ish to slightly overweight position in equity would have been okay for the portfolios. Equity returned about 5% over the year, so we'd have benefited from that. However, our emerging market position would have detracted from performance. As we know, emerging markets returned minus 2% in US dollar terms, so that detracted from relative performance in the portfolios. Manager selection then, we had a great year in terms of manager alpha in 2013. 2014, some of that was given back, unfortunately, and hence that weighed on returns as well.
If I may, James, I wanted just to draw you on the EM position and then maybe the government bond position. Now, as you said, they've not necessarily worked this year. Is it a case of you, as the portfolio manager, needing to kind of stick to your conviction on this one?
Well, on the emerging market equity side, we have to constantly question our positions. We'd be wrong to be naively sticking to our knitting, if you like. And clearly there are headwinds that emerging markets face today, but most of those are macroeconomic headwinds. I mean, the strong dollar, for example, is something that should be a cause for concern from a macroeconomic perspective and potentially for a debt holder perspective. It doesn't necessarily bode badly for the corporate sector. And the fall in oil, conversely, it's very good for consumer. Tend to have a large energy component in the consumption basket, so that gives them a lot of breathing space. It's effectively a tax cut. We should see more activity on the consumption side, should bode well for corporate profitability therefore. So that's a very short-term phenomenon. That's not why we're invested in emerging markets, but it's another example of why we might see a good outcome for emerging market equities. Moving on to the debt side, you mentioned high quality sovereign debt. We really, again, it's a valuation argument for being lowly allocated there. We're getting 2%, in fact sub 2% today from the likes of the UK 10-year, the US 10-year, and in fact the German 5-year Bund is in negative yield territory, so you're having to pay to lend to the German government for 5 years, which is a remarkable state of affairs. The markets are either telling us that the yields are being kept artificially low by extraordinary monetary policy, QE and the like, or they're expecting poor GDP growth and probably negative inflationary scenario, or some other risk aversion trade where bonds are the only place you want to be allocating today. Of those three scenarios, we still have extraordinary policy, monetary policy, so that's part of it. Do we see deflation? Only in Europe potentially there's a risk of deflation. I don't see risk in the US and UK, for example. So maybe it is just a case of people really don't see anywhere else that's a true safe haven today. Maybe that's a crowded trade. It does look expensive to us. The risks look asymmetric to us. You've only got a limited upside from here mathematically. You've got a reasonable downside from here actually. And so while we don't want to be completely without government bonds in our portfolios, they're a useful risk diversification tool, and they do provide a port in a storm. We don't want to have too much in the portfolios today because we do think it's expensive.
How are the managed solutions portfolios positioned today?
We've continued with the same philosophy we've had over the second half of last year really in terms of how we position the portfolios. We've got a small overweight to global markets, but we try and trim our US weight slightly. We think that's a little bit on the expensive side compared to the other developed markets, and it relies on having consistent earnings growth from these kind of valuation levels to justify the valuation you're seeing in the US. Better off in the likes of UK, Europe and Japan. We are overweight emerging markets, again valuation story, and we think that we have to be careful of position sizing there, but a modest overweight to emerging markets is a prudent thing to do, or a good opportunity I suppose in the portfolios. Underweight government bonds, they are expensive but the ultimate safe haven, so we take positions in various parts of the credit market to bring up our interest rate sensitivity, so we're not overly exposed to that underweight position there. And then finally we've got a decent amount in cash still, dry powder if you like, that we can put to work in the markets as and when opportunities present themselves in the coming year.
And finally, looking forward to 2015, James, what can we expect?
Well, we recorded yesterday a 2014 review and outlook of 15, and I would encourage people, if they want real detail, to have a look at that video. But in summary, more of the same really. Equity markets don't look too expensive. They don't look particularly cheap today. They're sort of a rich fair value, but they still look pretty good compared to the variety of other asset classes available to us, particularly government bonds, which look expensive, and even the credit market in places. You need to trade carefully today to make sure you're buying genuinely cheap assets. We think that volatility will continue to be elevated this year. We've seen the last couple of years volatility has been low, unusually low. We saw it spike up in sort of September to November last year, and those kind of conditions are much more the kind we expect to see this year. Much more regular returns of volatility, maybe even a sort of consistent elevation in volatility throughout the year. In that environment, risk controls are very important. It's key to build that into your portfolio construction process. Make sure you don't have too many eggs in any one basket. A diversified base of returns driver in the portfolios, but a portfolio that's still positioned for growth. Ultimately, we're not particularly negative on equities, on the global economic outlook. There's a lot of green shoots, a lot of reasons to be positive. Plus, even where it's looking a little bit bleak, we've got a lot of central bank activity to sort of provide the foundation for a reasonable year.
James, thank you very much.
Thanks, Richard.